Hello everyone, this is the Monte Carlo Risk Validation Tool. It was built for one simple reason. A good-looking backtest is not enough. Most traders look at profit factor, or a smooth equity curve, and they think the system is ready. But in real trading, that is where the danger starts. A strategy can look strong on one fixed historical path and still break when the trade order changes, when losing streaks come earlier, when drawdown expands, or when market conditions become more hostile. This tool uses real MT4 and MT5 statement data. It reads the closed trades, then rebuilds the strategy across many alternative paths. It can reshuffle trades, resample trade sequences, run block bootstrap tests, measure retention, stress drawdown, analyze streak pressure, test bad month clustering, detect survival failure, and show how fragile or stable the strategy really is. And it goes deeper than a normal Monte Carlo test. On top of that, it looks at market regimes, portfolio stress, correlation pressure, scenario shocks, survival failure, and capital allocation quality. So the question is no longer, did this strategy make money in the past? The real question is, would I still trust this strategy with capital when the path becomes harder? That is why I built this tool, not as a toy, not as a cosmetic report, but as a serious risk layer between a backtest and real money. Because before a strategy goes live, it should prove that it can survive pressure. Now we start with the statement upload. For this tool, it is important to upload a detailed MT4 or MT5 HTML statement. A normal statement can miss important information, especially around drawdown, deposits, withdrawals, and trade sequencing. The detailed statement gives the tool the correct closed trade structure, so the calculations become much more accurate. After the upload, the system reads the trades automatically. The filter section lets us choose exactly what part of the statement we want to analyze. We can analyze the full portfolio, EA trades only, manual trades only, or go deeper by filtering one specific symbol plus magic number. That means we can test the entire account as one portfolio or isolate one individual robot and analyze that robot separately. In this example, I keep everything on all, so we are looking at the full portfolio structure. Before running the Monte Carlo simulation, the tool first shows the parsed statement overview with trades, net profit, profit factor, win rate, SQN drawdown, recovery factor, MAR ratio, ulcer index, and time underwater. Ulcer index shows how painful the equity pressure was. Time underwater shows how long the system stayed below its previous equity high. MAR ratio compares return against drawdown risk. So before we stress test anything, we first understand the original portfolio. Now we are in the Monte Carlo settings. At the top, we choose the preset. Custom is manual control. The other modes go from a quick check to stronger stress, and finally to full survival pressure. After choosing a preset, we apply it here. Below that, we control the run setup. Run set the number of simulations. Sequence mode controls how the trades are mixed. Here we can reshuffle the trades, resample them, use block bootstrap, or test all sequence modes together. Random seed keeps the result repeatable. Curves to show controls the visible equity paths. Together, these settings decide how deep and how strict the Monte Carlo test will be. Here I keep the preset on custom so I can control the stress settings manually. First, I set the Monte Carlo starting balance. This should match the balance from the uploaded statement so the simulation starts from the right capital base. Then I enable skip trades. This tests what happens if a small part of the trades is missed. I also add slippage and spread pressure because live execution is never perfect. Next, I enable bad month clustering. This groups difficult periods together instead of spreading the stress evenly. The confidence settings in verdict mode control how the result is interpreted. Here, the quick verdict stays on soft mode for a lighter first read. Then I enable the institutional layers. Regime Monte Carlo checks different market conditions. The portfolio component layer checks how the robots or systems interact. Correlation stress adds pressure when systems become more connected. Finally, I enable the capital allocation engine. The allocation mode is set to balanced, so the tool looks for a middle ground between return, drawdown, survival, and diversification. So this custom setup is already much deeper than a normal Monte Carlo run. Now we move into the advanced stress layers. I enable the scenario stress engine here, and for this walkthrough, I keep the default values. This layer adds hostile market events on top of the normal Monte Carlo simulation. Crash events simulate sudden negative shocks. Volatility spikes test what happens when the market becomes unstable. Liquidity drought adds pressure when execution becomes harder and market conditions become thinner. Execution regimes simulate worse broker conditions like higher spread and higher slippage. Dynamic position sizing can reduce exposure when drawdown pressure becomes too high. Portfolio rotation simulation adds optional rotation pressure. Crash frequency controls how often crash-style pressure is injected. Crash shock strength controls how hard that crash pressure hits the strategy. Volatility spike frequency controls how often unstable market behavior appears. Volatility spike strength controls how aggressive those volatility events become. Liquidity drought frequency controls how often thinner market conditions are simulated. Liquidity drought strength controls how much pressure is added during those periods. Spread and slippage multipliers increase execution costs under stress. DD reduction. Trigger and DD reduction factor control when and how much exposure is reduced. Dynamic sizing mode defines the risk reduction logic. Compounding cap limits how aggressive the simulation can become. Rotation skip adds optional portfolio rotation pressure. Then we move into survival and death detection. Here I enable death detection and keep the default values. This layer decides when a simulated run should be considered structurally failed. Death drawdown marks a run as dead if drawdown becomes too high. Minimum final equity checks if the account finishes too weak. Minimum return over drawdown checks if the reward is still worth the risk. Max underwater duration checks if the strategy stays below its previous high for too long. So this final layer asks one simple question. Did the strategy actually survive the pressure? Now I start the result walkthrough with survival mode. This is the heaviest preset inside the Monte Carlo tool. Survival mode is not designed to make a portfolio look good. It is designed to apply the strongest pressure and see where the structure starts to break. Here I apply the preset, and you can see that the settings become much stricter. The run count is set, the sequence mode is selected, and the stress layers are active. This means the simulation is not only reshuffling trades, it is also testing skipped trades, execution pressure, bad month clustering, and deeper institutional layers. Now I start the Monte Carlo test. While the progress bar is running, the tool is building many alternative paths behind the scenes. It is not just replaying the original backtest. It is creating different possible versions of the same strategy path. The tool checks how profit changes, how drawdown expands, how long recovery takes, how often the system goes underwater, and whether the strategy still survives under pressure. That is why the progress bar is split into different steps. The system is running the simulations, building the stress results, calculating survival behavior, and preparing the result tables. Once the simulation is finished, the first section we see is the Monte Carlo baseline. This is the original account structure before we interpret the deeper stress results. Here we can see the starting balance, final balance, net profit, profit per day, max drawdown, return over drawdown, ulcer index, MIR ratio, recovery factor, time underwater, and the drawdown percentiles. This gives us the reference point, so before we judge the stress result, we first understand what the original portfolio looked like. After that, we move into the quick verdict. Here, the tool gives the first high-level interpretation of the run. In this case, the verdict is dangerous, and the mode is survival mode. That is important because survival mode is the harshest interpretation layer. It is designed to push the portfolio through maximum survival pressure. So, a harsh result here does not mean the statement never made money. It means the portfolio is being tested under the strongest survival conditions. Below the verdict, we move into the stress and expansion metrics. This is where the tool shows how much the structure changed under pressure. DD expansion shows how much drawdown expanded. Return over drawdown retained shows how much efficiency remained after stress. Recovery expansion shows how much harder it became to recover. Underwater expansion shows how much longer the portfolio stayed below its previous high. Tail AVG profit retained shows how much profit remained in the weaker simulations. Tail worst DD expansion shows how bad drawdown became in the worst areas of the test. Dead runs shows how many simulations failed under the survival rules. Median time to death shows how long it took before the failed runs broke. And worst 10% profitable months shows how much monthly survivability remained in the worst part of the distribution. So this section is not just showing profit or loss. It is showing how badly the portfolio structure degrades when survival mode applies maximum pressure. After the baseline and the first stress metrics, the tool explains why this verdict was given. This is important because the verdict is not just a random label. Under the result, we can see the main reasons behind the decision: drawdown expansion, return over drawdown retention, recovery pressure, underwater pressure, tail behavior, dead run pressure, and monthly survivability. So instead of only seeing dangerous or healthy, the user can also see what caused that verdict. Then we move into the three-layer verdict. This splits the result into three separate lenses. The structural lens looks at how much the strategy degrades under stress. The survival lens focuses on whether the strategy actually survives the simulation. And the deployment lens combines those signals into a practical capital decision. Below that, we can open the detailed three-layer verdict section. First, we see the structural lens. This shows the structural stress metrics behind the verdict, like drawdown expansion, recovery expansion, underwater expansion, and tail behavior. Then we move into the survival lens. This focuses on failed runs, survived runs, time to death, and the main reason why simulations failed. After that, we reach the deployment lens. This combines the structural and survival information into a final deployment-style interpretation. So this part of the report is not only showing the result, it is showing the logic behind the result. After the detailed three-layer verdict, the tool moves into the final decision section. Here we get the main conclusion of the run. In this survival mode example, the final decision is reject under hostile conditions. That means the portfolio failed once the heaviest survival and scenario pressure was applied. Below that, we also get the portfolio summary verdict. This looks at the portfolio structure as a whole, especially whether the component drawdowns become too aggressive under stress. Then we move into the allocation verdict. This is an important part because the allocation layer can give a different view than the full portfolio verdict. Even when the full portfolio is rejected under heavy stress, the allocation engine can still find a cleaner capital split. Here, the allocation verdict shows deploy. That means the suggested allocation structure looks much healthier than the raw full portfolio exposure. Below that, we can see the allocation comparison metrics. This shows how the portfolio changes after the allocation logic is applied. The tool compares baseline drawdown, allocated drawdown, return over drawdown, dead runs, capital concentration, effective system count, correlation pressure, and quality score. So this section is not only asking, did the full portfolio pass? It also asks, can the portfolio become healthier if capital is distributed differently? Then we see the reasons behind the allocation verdict. The tool explains whether allocation reduced tail drawdown, improved return over drawdown, improved survival, and kept concentration or correlation pressure acceptable. Finally, we move into the allocation input summary. This shows the input structure behind the allocation engine. The allocation mode, number of components, top weight, effective system count, total capital, correlation behavior, and how many systems are treated as core, support, or satellite systems. So this part of the report gives a high-level view of the capital allocation layer. It does not only show a verdict, it shows how the portfolio could be rebalanced under stress. Next, we move into the allocation weights. This table shows how the capital allocation engine distributes capital across the different components in the portfolio. Instead of giving every robot or system the same exposure, the tool suggests weights based on stress behavior, drawdown pressure, retention, and diversification. We can see the component name, the weight percentage, the capital amount, the allocation bucket, median profit, worst 10% profit, and drawdown behavior. So this section shows which systems receive more capital and which systems are kept smaller because they carry more risk. There is also a button to download the allocation weights as a CSV file. After that, we move into the allocation comparison summary. This compares the original portfolio against the allocated version. Here, the tool shows how profit, drawdown, return over drawdown, dead runs, concentration, correlation pressure, and quality score change after the allocation logic is applied. The important point is that allocation is not trying to maximize raw growth. It is trying to reduce risk and create a cleaner capital structure. That is why the allocated equity can look flatter than the original equity curve. The capital is spread across systems instead of letting every component run with full exposure. Then we move into the allocation-weighted Monte Carlo curves. These curves show how the portfolio behaves after the allocation engine has reduced exposure per system. The result may look less explosive, but the goal is more stability, lower drawdown risk, and better survival behavior. Below that, we see the allocation-weighted histograms. These show the distribution of profit, max drawdown, return over drawdown, SQN losing streaks, and drawdown duration after allocation. So instead of only seeing one equity curve, we can see how the allocated portfolio behaves across many simulated outcomes. Then we reach the baseline versus allocation comparison charts. These charts make it easier to compare the raw portfolio against the allocation-adjusted version. Finally, the median equity comparison shows the difference between the baseline median curve and the allocation equity curve. The allocation curve can look flatter, but that is expected. This layer is built for lower risk, better diversification, and cleaner capital control, not maximum growth at all costs. Next, we move into the scenario verdict. This section focuses only on the scenario stress layer. Here, the tool shows whether the portfolio can survive when hostile market events are injected into the Monte Carlo run. In this example, the scenario verdict is failure-prone. That means the portfolio becomes too weak once the extra scenario stress is applied. Below the verdict, we can see the main scenario metrics. These show how much profit is retained, how much drawdown expands, how much return over drawdown remains, how many runs fail, and how much cost or profit damage was added by the scenario layer. The tool also explains why this scenario verdict was given. So again, the user does not only see a label, they can also see the pressure points behind the decision. After that, we move into the scenario stress summary. This section shows the actual scenario profile that was applied. Here we can see the scenario intensity, the scenario frequency, the window size, how many runs were affected, how many trades were hit, how much cost was added, how many trades were skipped, and how much profit changed under scenario pressure. This is important because bad month clustering and scenario stress can overlap. So the test can become very aggressive on purpose. That is not a bug. It means the tool is testing hostile survival behavior. Then we move further down into the second part of the scenario metrics. Here we can see the worst 10% profit delta, the median profit under scenario, the worst 10% profit under scenario, the max drawdown under scenario, return over drawdown under scenario, dead runs under scenario, and the sizing modes. So this section shows how the portfolio behaves after the hostile scenario layer is added. Finally, we reach the scenario comparison summary. This table compares the original baseline against the scenario-stressed version. It shows baseline profit versus scenario median profit, worst 10% profit, profit shift, drawdown behavior, return over drawdown, dead runs, monthly survivability, and sizing mode. So this part of the report answers one simple question. How much does the portfolio weaken when the market path becomes more hostile? Next, we move into the survival and death detection summary. This section shows how many Monte Carlo runs survived, how many failed, how fast the failed runs broke, and what the main failure reason was. Here we can also see the median final balance for all runs, for dead runs, and for the surviving runs. So this section is mainly about survival behavior. It tells us whether the system only looks good on average, or whether it can actually stay alive under stress. After that, we move into the tail risk summary. This focuses on the worst parts of the simulation. The worst 5% and worst 10% buckets show what happens when the path becomes ugly. This is important because live trading is not only about average performance. It is also about what happens when the worst side of the distribution appears. Then we move into the all sequence modes breakdown. Because all sequence modes are active, the tool compares reshuffle, resample, and block bootstrap behavior. This shows how the same trade data behaves when the path is rearranged in different ways. So, instead of trusting one historical order, the tool checks multiple path assumptions. After that, we reach the Monte Carlo curves. The thick blue line shows the original equity path. The lighter curves show the alternative Monte Carlo paths. This gives a visual view of how wide the possible outcomes become when the trade path is stressed. Then we move into the confidence table. This table shows how the results change across different confidence levels. At lower levels, the results are closer to the better or more central outcomes. As we move deeper into the confidence levels, the table shows more hostile outcomes. Here we can compare profit, drawdown, return over drawdown, SQN, win-loss behavior, profit retention, drawdown expansion, streaks, recovery duration, and underwater duration. The goal is not to explain every number in this walkthrough. The goal is to show that the tool gives a full stress table, not just one final score. Then we move into the streak and duration percentiles. This section focuses on losing streaks, winning streaks, drawdown duration, average recovery duration, and longest underwater duration. This is important because a strategy can make money and still be very difficult to trade if recovery takes too long. After that, we open the Monte Carlo histograms. These charts show the distribution of net profit, max drawdown, return over drawdown, SQN, losing streaks, and drawdown duration. So instead of only looking at one curve, we can see how the results are distributed across all simulations. Then we move into the time-based bad month clustering summary. This shows how the bad month clustering layer affected the portfolio. It tells us how many bad months were triggered and what profit looked like under cluster stress. After that, we reach the regime segmentation snapshot. This breaks the statement into different market regimes, such as trend up, range, high volatility, and trend down. The tool shows how many trades happened in each regime, the net profit, win rate, profit factor, average trade, and share of trades. Then we move into the regime Monte Carlo breakdown. This shows how each regime behaves under Monte Carlo pressure. It helps reveal whether the portfolio depends heavily on one specific market environment. Finally, we reach the correlation stress summary. This section checks whether the portfolio components become more connected under stress. That matters because systems can look diversified in normal conditions, but become more correlated when the market becomes harder. So this whole part of the report gives the deeper structure behind the run. Survival behavior, tail risk, sequence behavior, confidence levels, distributions, bad month clustering, regime behavior, and correlation pressure. Next, we move into the portfolio component stress decomposition. This table breaks the portfolio down by individual components, robots, symbols, or magic number groups. Here we can see how each component behaves under stress. How many trades it has, how many losing trades, the median profit, the worst 10% profit, and the drawdown behavior. This is useful because a portfolio can fail as a whole, but the real pressure often comes from specific components inside it. So this table helps identify which systems are carrying the structure and which systems are adding weakness. After that, we open the monthly and quarterly view. This section shows the original monthly and quarterly returns. It gives a simple time-based view of the statement before the deeper Monte Carlo interpretation. Below that, the monthly and quarterly distribution summaries show the worst month, best month, and the percentage of profitable months or quarters across the stress levels. So this section helps connect the Monte Carlo result back to real calendar-based performance. Then we move into the parsed trades table. This is the raw trade data that the tool extracted from the detailed statement. Here we can see the source file, ticket, open time, close time, trade type, symbol, magic number, and symbol plus magic grouping. This is important because the whole analysis starts from the actual closed trades. The tool is not guessing. It is reading the statement, parsing the trades, grouping them, and then building the Monte Carlo analysis from that data. Finally, we reach the export section. Here, the full evidence package can be downloaded. The user can export the full ZIP package, the PDF report, the full JSON file, and all key CSV tables. That includes confidence data, parsed trades, survival results, allocation data, scenario output, tail risk, streak data, monthly and quarterly returns, and component results. So the output is not locked inside the page. Everything can be reviewed, stored, checked, or used later for deeper analysis. This completes the survival mode walkthrough. In this mode, the goal was not to create a pretty result. The goal was to show how the tool exposes pressure, survival risk, component weakness, allocation behavior, scenario stress, and exportable evidence. Now that the survival mode comparison is complete, I switch to the soft mode preset. I do this again from the preset selector at the top. After selecting soft mode, I apply the preset. The tool now updates the Monte Carlo settings automatically. The quick verdict mode also changes automatically to soft mode, so I do not need to adjust that manually. For this soft mode run, I am not going through every table again. We already covered the full report structure in survival mode. Now the goal is only to see how the same portfolio behaves under a lighter interpretation. Soft mode is still a Monte Carlo validation mode, but it is less aggressive than hard mode and much lighter than survival mode. It gives a softer first structural read before moving into stricter presets. This makes it easier to compare the three levels: survival mode for maximum pressure, hard mode for stricter deployment style validation, and soft mode for a lighter first scan. Now I start the soft mode Monte Carlo test. This run finishes very fast because soft mode is the lightest preset. The progress bar only takes a moment, so I go straight to the main verdicts. First, we see the quick verdict. Soft mode now shows healthy. That means the system maintains structural integrity under the current stress framework. Then we move into the three-layer verdict. Structural is healthy, survival is healthy, and deployment is also healthy. So under this lighter interpretation, the portfolio stays stable across all three verdict lenses. After that, we check the final decision. Here the tool shows deploy. This is the key difference compared to survival mode. Survival mode was the harshest pressure test, but soft mode gives the lighter first structural read. So now we can clearly see how the same statement reacts under different levels of stress. And this is the real purpose of Monte Carlo validation. It is not only asking if the statement made money, it is asking how much pressure the structure can handle before it starts breaking. A live account can be profitable and still show weakness under extreme stress. That does not automatically mean the account is bad. It means the tool is exposing where the pressure begins. Monte Carlo shows the portfolio level stress behavior. But if we want to know which robots are creating that pressure, we need the next tools. The strategy intelligence report reads the full statement structure: profit, drawdown, recovery, consistency, outlier dependency, capital readiness, and deployment risk. The EA breakdown goes deeper into the portfolio itself. It separates robots, symbols, and magic numbers so we can see which systems are strong, which ones are weak, and which ones may need to be watched or removed. And the drawdown survival simulator can then test whether the clean structure survives better. The Advanced Analysis Lab goes even deeper into the equity path and portfolio structure. It studies equity behavior, path smoothness, recovery strength, clustering pressure, burst dependency, portfolio combinations, and correlation between robots. So Monte Carlo shows the pressure. Strategy intelligence reads the full statement. EA breakdown finds where the pressure comes from. Drawdown survival tests whether the cleaned structure survives better. An Advanced Analysis Lab helps study the path, combinations, and correlations more deeply. That is the full workflow. The goal is not to show perfect results only. The goal is to understand the structure behind the results. The website link is in the description. The analysis tools shown here will remain free. There is a lot of work going into the platform, the tools, and the website. New tools, new modes, and new improvements will keep coming, and the analysis tools will stay free. Later, there will also be an EA Builder. More about that will come later, but I will say it clearly now. The EA Builder will be a paid tool. I cannot make absolutely everything free, of course. But the goal is to keep giving traders access to better analysis, better validation, and better risk tools without locking the basic workflow behind expensive institutional software.